you're sitting at the dinner table going over your personal finances? You owe the bank for your mortgage, you've got a car loan, maybe some credit card debt. Pretty normal, right? But what if I told you that almost every country in the world is also sitting at a giant table, going over their own debt? Not just millions, not even billions, but trillions of dollars. And here's the crazy part. They all owe money to someone. But who? Who do they owe? And if everyone's in debt, who's actually collecting on all this money? In today's video, we're breaking it down. Why every country is in debt, who really owns the world's debt, and whether this mountain of IOUs is as terrifying as it sounds, or if it's just how the modern world works. Why every country is in debt. Let's start with the basics. Why do governments borrow money in the first place? Because they spend more than they earn. Just like a household that spends more than its paycheck, countries that run a deficit need to make up the difference somehow. And that somehow is usually by borrowing. Governments collect money through taxes. They spend it on things like schools, healthcare, roads, the military, and, let's be honest, a lot of other things you may or may not agree with. When the expenses are bigger than the taxes collected, the country runs a budget deficit. To cover that deficit, they issue debt. In simpler terms, they borrow money from investors, foreign governments, or even their own citizens. Now you might be thinking, why don't they just spend less or raise taxes? Well, they could, and sometimes they do. But cutting spending is unpopular. Imagine telling voters they're getting less healthcare or higher retirement ages. And raising taxes? That's not a great vote winner either. So borrowing becomes the path of least resistance. And before you know it, boom, national debt. How government debt works. Okay, so how does a government actually borrow money? They sell bonds. A bond is basically an IOU. Let's say you buy a government bond for $1,000. The government promises to pay you back in, say, 10 years plus interest along the way. Governments issue these bonds to raise cash. Investors buy them because they're seen as safe and stable investments. In fact, US government bonds are often called risk-free because Uncle Sam has never defaulted on its debt. Countries borrow at different interest rates depending on how trustworthy they are. The safer investors think you are, the lower your borrowing costs. If investors think you're risky, they demand higher interest rates. That's why countries like the US, Germany, or Japan can borrow cheaply. While countries in financial trouble, think Argentina or Greece, pay through the nose. How much debt are we talking about? Now let's zoom out. How much debt are we really talking about? As of 2024, the total global government debt is over $300 trillion. Let that sink in. That's more than 3 times the entire world's annual economic output, or GDP, and it keeps growing. For example, the US has over $34 trillion in national debt. Japan's debt is over 250% of its GDP. Even developing countries carry huge debts relative to their economies. But here's where things get weird. Almost every country is in debt, even the richest ones. So who do they owe all this money to? And who's holding the bill? Who really owns the world's debt? The first place to look is bondholders. Most government debt is held by a mix of domestic investors, foreign governments, financial institutions, pension funds, central banks, and regular people like you and me. Let's take the US as an example. About 2/3 of US government debt is owned by Americans. That includes pensions, mutual funds, insurance companies, and the Federal Reserve. Roughly 1/3 is held by foreign countries. And who are the biggest foreign holders? China, Japan, the UK, and smaller amounts by places like Ireland, Luxembourg, and the Caribbean banking centers. So, in the US, Americans essentially owe a lot of money to themselves, and this pattern repeats elsewhere. In Japan, the majority of government debt is held domestically. Same with countries like Italy and the UK. But in developing nations, the story is different. They borrow a lot from international lenders like the World Bank or the International Monetary Fund, and sometimes from wealthier countries looking to expand influence. The global debt web. Who owes whom? Think of the global debt system as a giant spider web. Everyone is interconnected. Countries lend to each other, invest in each other's bonds, and borrow from global institutions. China owns U.S. debt. The U.S. owes money to Japan. Japan borrows from its own citizens. France lends to developing countries in Africa. Saudi Arabia invests in U.S. bonds. And on it goes. It's not always about needing the money. Sometimes it's about trust and stability. Investors buy government debt because it's seen as a safe place to park cash. And countries buy each other's debt to build alliances, strengthen economic ties, or maintain leverage. But who really owns the debt? This brings us to an interesting question. Who really holds the cards? If everyone owes money to everyone else, does anyone really own the world's debt? The answer? It's complicated. But if we look closely, the key players are large institutional investors, central banks, wealthy countries with trade surpluses, like China and Germany, and multinational financial institutions like the IMF and World Bank. These are the groups that hold huge portions of global debt. They call the shots when things get rough. They decide when to renegotiate debt terms. They decide who gets bailed out. And often they set the rules of the game. Is all this debt a problem? Now, you might be thinking, wait, isn't all this debt dangerous? What if countries can't pay it back? And the answer is, sometimes. Debt can be a problem if it gets too big relative to a country's economy. High debt levels can make investors nervous, increase borrowing costs, lead to budget cuts or higher taxes, and in extreme cases, trigger defaults or crises. We've seen this happen. Argentina has defaulted multiple times. Greece needed massive bailouts during the Eurozone crisis. Sri Lanka recently defaulted and faced economic collapse. But for many wealthy countries, debt isn't as scary as it sounds. As long as they can borrow in their own currency, and as long as there's demand for their bonds, they can keep rolling over debt indefinitely. This is sometimes called the magic money machine. Because if you control your own currency, you can always print more money to pay off debt. Modern monetary theory. Can we just print money forever? This leads us to a modern idea called modern monetary theory, or MMT. MMT says countries that control their own currency can never run out of money. They can borrow and spend as much as they want. Inflation is the only real constraint. If inflation stays low, the government can keep borrowing forever. Critics say this is dangerous thinking. Printing too much money can lead to hyperinflation. Just look at Zimbabwe or Venezuela. Supporters argue we're already living in an MMT world. Governments spend, central banks print money, and inflation has stayed mostly under control. At least until the pandemic, when we saw inflation surge, and governments had to slam the brakes. The role of central banks in national debt. Central banks play a huge role in government debt. Take the Federal Reserve in the US. It buys government bonds on the open market. This puts cash into the system and keeps interest rates low. Japan's central bank takes it even further. It owns over 40% of all Japanese government bonds. That's like the government lending money to itself. It's a strange system, but it works, for now. If central banks hold too much debt, it can distort markets. It can make it harder to unwind policies when inflation rises. But it also shows how governments and central banks work hand in hand to manage debt. What happens if a country defaults? So what happens when a country can't pay its debts? This is called a default, and it's messy. The government can't borrow more money. It might have to slash spending. People lose jobs. Inflation can skyrocket. And the country's credit rating tanks. This happened in Greece in 2010. It triggered a Eurozone debt crisis, mass protests, austerity measures, and years of economic pain. But defaults aren't always the end of the world. Argentina has defaulted multiple times. It still borrows money, albeit at higher rates. Lenders often restructure debt. They accept less money back to avoid losing everything. Debt forgiveness. When do countries get a break? Sometimes countries get debt relief. Poor nations burdened by massive debt can't grow. They spend more on debt payments than healthcare or education. So groups like the IMF, World Bank, and wealthy nations forgive some of that debt. This happened with the Heavily Indebted Poor Countries initiative in the early 2000s. Dozens of countries in Africa and elsewhere got partial debt relief. The goal was to give them a fresh start. But critics argue debt relief often comes with strings attached. Countries must follow strict economic reforms, and sometimes those reforms hurt ordinary people more than they help. Who benefits from national debt? Not everyone sees debt as a bad thing. In fact, many people and institutions benefit from government debt. Bondholders earn interest. Governments use debt to invest in infrastructure, education, and healthcare. In the US, Social Security surpluses are invested in government bonds. That's part of what funds retirement benefits. And debt can help economies grow if it's used wisely. Borrowing to build a new highway can boost productivity. Borrowing to fund tax cuts for the wealthy? Less so. The key is how the debt is spent. Smart investments pay off. Bad spending creates problems. The real cost of too much debt. When debt gets too big, governments may face hard choices. Higher taxes, lower spending, or inflation. Inflation reduces the real value of debt, but it also hurts savers and workers. Hyperinflation can destroy economies. We've seen it happen in Weimar Germany, Zimbabwe, and Venezuela. But controlled inflation can be a part of a debt management strategy. It's a delicate balance. What would happen if every country paid its debt? Here's a fun thought experiment. What if every country suddenly paid off its debt? It sounds like a great idea, but it could actually cause chaos. If governments stopped issuing bonds, there'd be fewer safe investments. Interest rates could rise sharply. Pension funds and insurance companies would struggle. And global markets could panic. Debt, for all its flaws, is a pillar of the modern financial system. The bottom line. So, why is every country in debt? Because debt is how governments fund services, invest in their economies, and manage ups and downs. Who really owns the world's debt? A mix of central banks, financial institutions, foreign governments, and ordinary investors. Is all this debt a ticking time bomb? It depends. Debt isn't inherently bad. It's a tool. Used wisely, it can fuel growth. Used recklessly, it can lead to disaster. The world runs on debt, and for now, it's working. But as with all things in finance, there's a fine line between stability and crisis. Conclusion and final takeaway. Understanding how global debt works helps us see the bigger picture. It's not just numbers on a screen, it's decisions that impact economies, jobs, and people's lives. Governments, central banks, and institutions all play a role, and so do we as voters, investors, and citizens. The next time you hear someone say, the national debt is out of control, take a step back, ask, compared to what, and who benefits? Debt is complex, but it's not going away. The key is understanding how it works, so we can make smarter choices for the future. Thanks for watching. If you found this video helpful, give it a thumbs up. Subscribe for more explainers and share it with someone curious about how the world really works.